Good morning, ladies and gentlemen. This is Butch Shorek. It's Monday, July 23rd, 2012, and this is Options University. Access to this webinar is for educational and informational purposes only. Nothing contained in this video, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Options University provides educational services that are meant to teach you the risks and rewards of trading stocks and options. We're not a service that tells you what to trade. We're not implying or guaranteeing any profits. And as always, do not trade with money that you cannot afford to lose. Well, with that thought, let's move on and take a look at what happened during the last week, as economic announcements had very little effect on the overall market. Expectations were to get some kind of news out of the Fed for some kind of quantitative easing, and that didn't happen. Earnings during the week, again, were somewhat disappointing, but in spite of that, Monday, Tuesday, Wednesday, Thursday, market kept its track upwards and kept moving on. On Monday, we had retail sales, we had Empire State Manufacturing, business inventories, the market went up. Consumer Price Index was not exactly stellar, the market went up. Housing Market Index was fine, but the market went up. Housing starts, a little bit of a brightness. Bernanke spoke at 10 o'clock on Wednesday. Not a lot to say, wanted to hear more out of him, and the market didn't hear anything from him. Jobless claims were disappointing on Thursday. And then, of course, we had existing home sales, which was okay. Philly Fed was disappointing. Economic leading indicators was disappointed. And for the week, nothing on Friday. But what we had on economic announcements was a frown. The world was not happy with economic announcements, but all through the week, the market headed up on this option expiration week. And then all of a sudden, on Friday, we began to move down. Let's take a look next at what's coming in the coming week. On Monday, very little information. That's today. Not much happening. All right, and then when we look on Tuesday, we see we got PMI, and we've got the Richmond Fed Manufacturing Index. We got the Housing Price Index. Again, nothing much there that's going to really move the market. New home sales on Wednesday, not anything of any major note. Looking at Thursday, durable goods orders can move the market. Our weekly jobless claims certainly has been known to move the market. Pending home sales could move the market. Probably won't, as the housing market hasn't been moving the overall stock market in recent years. Finally get used to these poor numbers. And then on Friday, we've got a consumer sentiment, GDP. These have been known to move the market. So for the week, jobless claims is the big one on Thursday. Friday, GDP, consumer sentiment. These are things that absolutely can move the market and very well may do so. And the week that was, as we saw, we reached a similar high that we had reached earlier. So we got we did get a little higher high, but when it was all said at the end of the day, we closed right at resistance in our yellow zone. And here's our first 4 days, which were definitely part of an upcycle in an uptrend as we're getting higher lows by this. Here's a low, there's a previous low, this low higher than that low, and then here we got a higher low, and we're getting higher highs, higher highs, higher highs, and then all of a sudden here we are. We didn't get a higher high, so we showed some weakness on this week, even though we continued our upcycle and our uptrend. Now we'll see whether that uptrend is going to continue by where we go as far as our next low. Targets, we've got two diagonal lines that are drawn on the chart. Those are our first targets. We've got the support down here at that previous low. And if we go lower than this low right across here, all right, we'll be out of our uptrend, which I always have been telling you might be a little suspect, might be kind of a little head fake. and we'll go into our sideways trend with a trading range potentially between 1380 and 1270. About 110 point potential range for our sideways summer trading range between now and our supposedly expected rally going into the fall portion of the year. Currently, we're in the summer doldrums, and the market actually has shown a bit of a strength. We got our July rally. July was the first month of the new quarter, and first months tend to be a bit more bullish than the other months on a statistical historical basis. So we got exactly what we expected. Now, my expectations are we're going to trade in a sideways pattern. Now, what will disprove that is if we break higher than this current point of resistance that we've established right there at about 1380. So we'll see what the future has to hold us at. In the meantime, we're on a short-term down cycle in an upward trend, looking for how low are we going to go for our overall support. All right, looking at a larger plot of the same SPX, we see that as we look at the last week, we had our huge day Friday a week ago, which really was a breakout. And that was our major entry for those of you that were bullish. And you see that on Monday we had basically an inside day, and then we continued our upward trek, getting basically just a slight bit above that previous high back here at the beginning of July. Huge down day on Friday. Economic news taking place during all these days. Earnings taking place during all these days. There was a little bit of excitement as earnings came out, and the bottom line, that is your profit line, earnings line, was not disappointing at all, but they were very low expectations. And then what we saw was so many of our companies missing on the top line, that is, how much money did they bring in, what were their revenues. And again, that lack of information from Bernanke out of the Fed for any quantitative easing. Some question whether Bernanke is willing to do anything at this particular point in light of the fact that we have our big national election coming up, and they don't want to be accused of influencing that election in any way, shape, or form. So SPX doing what SPX is doing during the summer, having trouble getting new highs, certainly getting new lows and higher lows, having trouble getting higher highs to retrace to where we've been at the beginning of the year. So with that thought, let's take a look at some of the other indexes. That's our granddaddy index, the SPX, which of course has the strongest companies in the entire world in it. And now let's move forward and take a look at the Dow. So looking at the Dow, last 5 days, it looks very, very similar. Monday was an inside day, and then it broke out. Actually went to a little bit higher high than we saw the other one going, but not much. And then Friday had its retracing its way back down, and see whether or not this moving average sitting right here, the 50-day moving average, can actually provide support, or whether we're going to go down here or down to this previous low. All right, so that's what the Dow looked like, following the overall pattern of the S&P. Next, take a look at the NASDAQ. We see the NASDAQ certainly has some big moves, and we see that we had a gap up on Thursday as the tech index certainly made a big move. And then Friday, of course, a huge move down. The NASDAQ tends to accentuate some of the moves that the more mature indexes have. That's our tech index, and tends to move with greater gusto. Looking at the Russell, we talked about before how the Russell many times can be a leading indicator. I talked about on Friday morning how the Russell had thrown a big candle, red candle on Thursday where the others hadn't, thus potentially giving us a leading indicator. And sure enough, Friday morning, we got a big gap down out of the Russell 2000 as it's going back to find some kind of support along the way. All right, with that, let's take a look at the week that was. Looking at our individual indexes, what kind of changes did we have? All of them for the Dow, NASDAQ, S&P 500, and Russell were in positive numbers, except for the Russell, which was down 10. Remember, it led us down. All right. Percent changes for the week. Actually, everything was positive for the week except for the Russell. Not all that much, but 0.4% for the Dow, NASDAQ 0.6, S&P 0.4. And if we look at year to date, we see that the Dow's up about 5%, NASDAQ's up about 12% in double digits, S&P up almost 10% at 8.4%, so trying for double digits, and the Russell itself is up about 7%, 6.8% year to date on the Russell. So we see that the market, in spite of the fact that we had our big pullback on Friday, by the way, which was options expiration week, we see that the market did end up with positive numbers, not by much, but certainly positive numbers for the week. All right, let's take a look at the VIX, and we see that as the market pulled back on Friday, the VIX popped up. No big surprise. Trading in our yellow zone between 20 and 15, where the market spends approximately 85% of its time, and it's doing and spending its time in that range. This is our fear index and tells us how much fear, how much volatility, and therefore how much premium there is in our option market. Looking at the bonds, we see that the bonds are sitting at the very, very top of that yellow zone, and it looks like if the market does continue to pull back, this very well could be a breakout. So for those of you that want to be perpetual bulls, you can always find a market or a sector that can be that. This happens to be the TLT, which is an ETF for the bond market, and you can watch for a breakout on this Monday and a potential of higher highs and breakout coming out of the bond market. TLT ETF for bonds. Next, we're going to take a look at the financial sector, which of course usually leads the market up, but we see some weakness here early in spite of the fact that the market was headed up. There was trouble with the financials continuing on up, as we had many earnings come out of the financials, out of some of the big companies like JP Morgan and Bank of America. And well, again, we talked about the fact that the bottom line, that is the profits, looked certainly okay. In the stock market, we call those earnings. But when we looked at the top line, that is how much money they take in, which we call revenues, there was disappointment in the financial market, and so while the overall S&P was going up, notice what happened during the week as the financials went sideways, giving us a tip that we're going to have trouble breaking on up through that previous resistance on the S&P. Looking at oil, the USO, the ETF for oil, we see that it has been rallying. And it's continued to rally, a bit of a pullback on Friday, but certainly didn't look like the rest of the overall market as we see oil moving its way up. And, they like to do that during the summer with all the vacation traveling. Looking at gold, we see gold is going absolutely nowhere. Certainly a candidate. This is GLD, which is an ETF, which trade, remember, ETFs trade like stocks. You can write covered calls against them if they're optionable, and many of them have enough volume to do that. You can do verticals with some of your ETFs, so there's potential here with a ETF that's going absolutely nowhere to make money on both sides, getting that free trade from your iron condor, based upon the fact that many of your brokerages don't charge you premium or charge you a holdback on the second part of your iron condor trade. So this certainly looks like one of them that one might think about maybe doing a call spread up here or a put spread down here, determine how far away you can get and still do it safely and look for the return that you feel is fair for your account and your risk tolerance. Looking at volume for the week, we saw that we continued on up. Had a very nice little rally through the week after that big move on Friday a week ago. And we saw that basically we were sitting there at about average volume, no big spikes in the volume during the past week. And we're just going through normal summer gyrations and cycles that the market goes through at all times. As it goes up, it goes down, it goes basically up for the week, but not by a heck of a lot. And it just continues taking advantage of this kind of thing. You can use 3 to 5 day trades, pulling premium out of the market, or however you decide to trade by being a bull and by being a bear, basically by following these cycles. So with that, the market for the coming week, we're in our next cycle as far as options expiration is concerned. We've got weeklies sitting there. We've got monthlies that are available to us. So all these things are available to us as we go into these summer months, looking at August and September, which generally are not a strong month as that July is, which is the first month of the new quarter. So with that, we're going to break into July and August here shortly, and into that new option cycle. So for those of you that are gold members, stick around. We're going to look at our stocks to watch, look at the charts, see how they responded during this earnings season. Some of them have earnings, some of them changed drastically, some of them are still the same company they were a week ago, and we're going to tear that apart and decide which is which. So for those of you that are gold members, stick around and we'll do that. For those of you that are not gold members, if you'd like to see more free videos, there will be a little blurb on the website after this a video, and you can see other places where you can see other free videos from Options University. So thank you very much for being here. This is Butch Shorak. It's Options University. We're in the first week of the new cycle. It's Monday, July 23rd, 2012. Thank you for allowing us to serve you, and thank you for being here.